Bruchim habayim to all of those who are joining us for the first time, and I know many of you are coming back again, repeat viewers. It's always, you're all welcome. Thank you for coming, and particularly we'd like to first of all express our thanks and for making it possible through the AACI. What a wonderful organization, and in particular Elena, who did amazing work putting all this together, to helping put this together, and Leah Rosenzweig as well, because you're giving all the technical support for tonight's financial seminar. So thank you all. We appreciate your help and your kindness. So if we're going to begin right away, and we're going to introduce Mark van Gelderen, who's going to give a general overview of some of the problems and how we might be able to address, and in particular, I'm sure, as we all want to hear, is to address and get solutions to perhaps some of the issues coming through today. And then we're going to bring to the program from New Jersey, Larry Solomon, who we'll talk about a bit later. And then we'll be opening it up to questions and answers. You'll be able to use the chat button at the bottom of the screen, and you can send me any questions that you want. And Bezrat Hashem, during the course of this seminar, we hope to address those questions. And if not, we'll follow up immediately afterwards. We're going to mute everybody for the moment, but you can continue to use, as I say, to use the chat button for any questions that you have or any suggestions. And then right after the seminar, within the next few days, you'll be receiving follow-up emails and other materials that will be coming your way, which we'll talk about a bit later. So without any further ado, I'd like to introduce the main speaker right now, Mark van Gelderen, who's going to give an overview presentation. And many of you know him as the co-founder of Financial Resource Network here in Israel since 1992. And it was been doing public lectures in BC before Corona. And now we're doing the seminars, and he's doing the seminars on Zoom. So I see also you have a PowerPoint presentation. So without further ado, let me introduce you to Mark van Gelderen.
Hi there. Leah, you're there? Okay, so hopefully all of you can see me. I'm going to start this by giving you just a little bit of background, which will be a little bit different than what you might expect. This book that I'm showing you right now has been sitting on my bookshelf for 41 years, and I've been waiting for the day when I would be able to put it to use. This was a book written during the great inflation in the late 1970s and early 1980s. The edition that I have was published in 1981, and I always had the feeling that at some point I would need to know what to do when the next significant inflation came along. And that's what has happened now. It's happened relatively quickly. We didn't have much advance notice. And Morton Shulman, who wrote this book, was at the time when he started to work on the problem of inflation, the coroner of the city of Toronto, Ontario, Canada. And he wrote versions of this book every 2 years because he admits in the afterword to the edition that I have in my hand that his advice was not good after about 6 months. So 80 to 90% of the book is not applicable to what we're going to talk about. I reread it quickly over the last few days, and there are a few things in there that are really amazingly important for us to know. Number one is, without giving away my age, people who haven't had these experiences usually don't understand what's going on and what needs to be done and why our thinking needs to change. Beyond that, he gives a couple of basic rules, which we will get to later on in the presentation. So why don't we go to the presentation, and we can go right past the first page and go on to page 2. And while Leah's bringing that up, I just want to give you a couple of disclaimers in terms of what's going on. We're not giving financial advice in terms of something that you should go out tomorrow and make a change or do something. Everything that we're saying tonight may be entirely different within 6 months, depending on whether inflation accelerates, whether it starts decelerating again. And the things that work today, even if inflation stays at the same level, may not be working the same way then. So what we're going to do is stick to the basics for people who just want to go and figure out how to stay ahead of the inflation curve and without having to work real hard at it and worry too much about it. Okay, so let's go on to the next page. In order for us to, no, we're still on page 1. We need to go to page 2. Okay, in order to quickly mentally understand how inflation works, there's the rule of 72. 72 is not a constant like pi when we're figuring out the area of the circle, but it's a shorthand way of figuring out the effects of inflation or in terms of growth of our assets. So the first example is if we have a growth rate of 10% a year, how long does it take for us to double our money? And that's 7.2 years, because 10 goes into 72 7.2 times. It's not an exact number, but it's a good estimation. Some people, for their calculations, go down as far as 69.3. Many mathematicians stick around with 71, but in order to explain the phenomena, most people use the number 72 to figure out how fast money grows or how fast you're losing money, which is the negative example. We have inflation of 10%, 10 into 72 is 7.2. It means that our buying power has decreased by 1/2 in 7.2 years. So a loaf of bread costs $1 today. In 7.2 years at 10% average inflation, it would cost $2. Okay, so let's go on to page number 3 now. How does this play out? So I put together a hypothetical situation, but something that Yitzchak and I and other financial advisors run into on a regular basis. Rivka recently lost her husband. She's age 70. She's in good health. She's been retired for 5 to 10 years. She made Aliyah from America. She has some pension and some Social Security, and the total of that comes to about $300,000 a month. She has savings she left back there of about $100,000. And because she got here some years ago, she had a short career here. And between Bituach Leumi, Kupot Gimel, and a very small pension, she's bringing in 7,000 shekel a month. So if we take all these numbers together in terms of her income that's coming in every month, it comes to, at today's exchange rate of around 3.1 shekel to the dollar, it means that she's having an income from her entitlements of about $16,300. Now, if this slide has changed from what I've sent you. My dear wife pointed out to me that it should be written up in a slightly different way, which is what I've done here. So if inflation is at 6% a year, that means in a year, she would need $14,840 to live on if she's able to live on $14,000 today. In 2 years, that number that she would need to keep her standard of living at about the same level, if there was 6% inflation continuing for a second year, means that she'd have to bring in $15,730. As you can see, very quickly, she would run out of money to be able to live at today's standard. At 6% inflation means that she needs twice as much money, meaning twice as much as she needed to live on, a $14,000 shekel. In 12 years, she'll need the equivalent of 28,000 shekel. To complicate things, we want Rivka to live a long and healthy life, which means that based on a person who's healthy at the age of 70, the average lifespan is still about 20 years, meaning that she lived on average to age 90. However, she might be above average in terms of her health. And as a result, as a financial planner, one should try to plan her assets to last for at least 35 years until age 105, which is not an unreasonable age to get to anymore. Okay, let's go on to the next page. Some of the people who are attending here today are people who are worried because they don't feel they have enough to get through retirement. So let's look at some of the factors. The problem is that most of us are getting most of our income from fixed income programs, Bituach Leumi, Social Security, pensions, etc. These, by their very nature, cannot keep up with inflation because by law, they have to have a lot of low interest paying bonds in them to provide long-term stability. Plus, there's issues like many more people are retiring today than are dying off, which is unlike the past. The average retiree lives for at least 20 years beyond when they start getting their pensions or whatever it is, where 30 years ago, the average lifespan upon retirement was 5.5 years. That's a huge difference. And pension funds, government, insurance agencies, etc., just cannot keep up with the change of demographics. Because many of us have most of our retirement income tied up in these fixed income programs, there is little money left over to go and try to do something to beat the system, which is what we're going to be talking about today. The cost of living for retirees inflates faster than the general inflation index. Why is that? Because there are more of us becoming retirees every day than the population is increasing. So you have supply and demand. The supply of retirees increases, which creates demands on the system where nursing homes, hospitals, etc., are not as expanding as fast as that cohort of the general population. We need to keep in mind that if we're running out of money in old age, the possibilities of getting a job part-time or even full-time becomes every year closer to nil. So that we need to think today about making sure there's enough to get us through our lives so we can live comfortable and lives without tremendous worries. Okay, let's go on to page 5. A few of you who are attending this probably are saying this to yourself. I have no room to breathe. I just don't have enough if inflation takes off or continues at this level or higher. So let's see if we can do a couple of things to help you. We don't want people to fall apart. We don't want you to think that nothing can be done, but we have a couple of suggestions. Start talking to people who can be helped. The AACI is a great source of information and assistance. For those of you who have recently come, Nefesh B'Nefesh can also help you. Your municipal social work department. Every municipality has a social work department, and they're there for these kinds of issues, to start talking to you and showing you where you can get help. Clergy, friends, and family are worth talking to. Don't hide in a closet, because that's only going to make things worse. There are areas where we can go and change our lifestyles in terms of the cost of housing, doing less dining out, perhaps, getting rid of the family car and instead using taxis and public transportation, which will save you thousands of shekel a month, doing less international travel, etc. Having said all these things, there is one thing that all of us need to have here in Israel, and we'll talk about it as we get to the end of the presentation, and that is an emergency fund. We need to have extra money on the side in case something happens where we all of a sudden need to pay some major bills. Later on, if any of you want more information, you can send Yitzchak a question and he and I will answer that further. Let's go on to page 6 now. Okay, there are certain areas that are non-financial, for the most part, that everyone should have in place that will make a big difference in terms of your quality of life in all likelihood. Of those people who are over age 80, over half will not be able to take care of themselves in the cohort of 80-year-olds. Of 90-year-olds, it's over 75%. So we need to, as early as possible, put together things to make sure that we're cared for. Israel has a wonderful law that came into existence less than 5 years ago called the Continuing Power of Attorney Law, Ipui Koach Mitmashech, and it provides you with all the answers about how to go and organize things, that someone will be there or some people will be there to take care of you. As part of it or separate from it, you should have an active care plan in terms of how do you go about doing things on a day-to-day basis. In my opinion, anyone going to a doctor and is above the age of 50 or so should never go to a doctor's appointment of any consequence by themselves. There should always be someone else with you who can take notes, ask questions, and remember what's going on. If you're living on your own, there should be somebody who every morning is calling you or knocking on your door to make sure that everything is all right. You need to be part of a social system where you have a social life and where dementia doesn't set in because of boredom. The younger you safety-proof your home, if you're planning to stay there long-term, means the safer you're going to be, to make sure that falling, which is a common cause of sudden decline, won't happen. And also to make sure that if you're living alone, that people have a key to get in and that you don't put the inside lock on at night so that people can get in to make sure you're right. It's also a time to go and revisit your health insurances. Israel has 3 levels of health insurance. One is automatic. The second level is from the Kupat Cholim, and you have to choose the right one. And the third one is a private health insurance, which might be too expensive if you're too old and haven't yet gotten it. So these are all things you can look into. If you need help, we can send you to qualified people to help you out. This next one is something that'll take me a minute to explain. But in New York, there was a study done, and they found that one of the most common causes of detecting dementia was when people became all of a sudden destitute. In other words, people who are starting to have dementia very often are giving away their money or sending it away without knowing what they've done. And the only time we find out that there's a serious problem is when all of a sudden the checks, credit cards, and everything else starts bouncing. So as we get older, it's important to have someone look over your shoulder. My good friend Martin Fetter, a attorney in Yerushalayim, does a lot of work with senior citizens, particularly with the Ipui Koach Mitmashech. And one of the things that he's come up with is the my guy syndrome. People who start living on their own depend on someone who goes and helps change the light bulbs, might deliver the groceries, is the taxi cab driver who can be depended on to pick things up and get me to where I need to go. If you have a my guy and you have an informal relationship, this is potentially dangerous and perhaps deadly. I won't go into details now because we have a lot to go through, and that's not the point of the seminar, but be aware that the my guy syndrome has the potential of doing a lot of good and also doing a lot of harm. Everyone thinks about a will, except wills are dead until you die. They only become alive after you are dead. Anything you've written in your will and thought through has no bearing on anything that's going to happen before you die. It doesn't have any legal standing until you're dead. Again, everyone needs an emergency fund in Israel, and we'll mention that again going further down the slide deck. Let's go on to the next page, page 7. Okay, let's get back to the math of inflation and give you some idea. Traditionally, the golden rule for how to plan for retirement is you take the person's age and you subtract it from 100, and the balance, in the example we've given you here, is age 80, meaning that the balance is 20, that's the percentage of your portfolio that can be somewhat aggressively invested. So let's take an example here with a round number, $1 million of wealth. $800,000 is in safe savings because the person is 80 years old. If you could get that 80,000 in safe savings to be yielding 2% a year at this point in time, you have a genius for a financial advisor. That would yield about $16,000 per year. If you had $200,000 that was put into blue chip investments or income yielding real estate at about 10% a year, that 200,000 will yield more than the 800,000 did. And it will yield $20,000. So your total income for a year with $1 million is $36,000, which is a 3.6% yield. And this number in Europe today is considered aggressive. I recently attended a seminar given by an investment bank for the very wealthy in Europe. And they said that they used to use 4% as the expected yield on retirement portfolios. Today, they feel that if they're lucky, they're getting 3.5% to be able to give out to retirees without eating up assets and without growing assets. The FiRN, the basic sum of money to keep up with inflation. So just keeping nominal amount of money and having a safe yield in Europe today is pushing the envelope at 3.5%. So let's see how this plays out. If we have growth of 3.6% and taxes of 25%, because we're here in Israel, and all growth in Israel, if we're beyond our tax holiday, is taxed at source at 25%. Therefore, we have to subtract from the 3.6% yield 0.9%. And if inflation is at 6%, that means when we add everything up, we're having, in reality, a minus 3.3% yield on our money, meaning that it is decreasing in value by 3.3% a year. If we go and plug that number into the rule of 72s, that's telling us that half the buying power will be lost in about 22 years. Actually, I believe it's 21.8. Okay, let's go on to the next page. Now, when we're talking about that 20% that might be invested for higher growth, the first thing that comes to everybody's mind, including mine, is risk. As far as I'm concerned, there are two kinds of risk in the world. There's risk based on volatility, like you can see in that graph there, where most of the time it goes up, but sometimes it goes down terribly. And there can be permanent or close to permanent loss where you lose a major part of your money and it's not retrievable. Okay, so there's two kinds of risks. So there are things we can find that are fairly dependable, where we're talking about dependability, meaning that there's reasonable volatility as opposed to the high chances of permanent loss. Since probably most of you are curious, I'm going to tell you what these two things are. The first one has a trading symbol of SDY, Sam David Yahoo. And it is an iShares, no, it's a State Street share ETF that is following what's called the, I lost my notes, just a moment. It's following the Dividend Aristocrats Index. The Dividend Aristocrats Index is an index of the top companies in America that have been giving steady or increased dividends for the last 25 years or more, meaning that these are companies that are not going anywhere and are dependable. So you have a group of about 50 companies that are put together in a fund that is following an index called the Dividend Aristocrats, and that will give you a steady return of dividends, but the share price may go up and down over time. The one on the right, which is showing permanent loss, is something that many of us grew up in and depended on for a good part of our lives. Sears Roebuck. It is down to about 18 cents a share right now and is not expecting any immediate or long-term major recovery. Okay, let's go on to page 9. So, going back to Morty Shulman's book from the 1980s, I pulled out a couple of ideas that I want to share with you. How do you go and beat inflation? You buy equity. Equity means something that goes up in value. These could be quality shares from the stock exchange or leading funds that follow principles like what I just explained to you about SBY. Real estate, in our case, it's going to be non-highly speculative real estate. Commodities, gold, silver, iron, and other things that can be bought on commodity exchanges or through the stock exchange. Precious metals, mentioned collectibles, things that you have developed as a hobby. Not diamonds, because diamonds for most people can't be bought at wholesale. They're only available at retail, which means that there's a tremendous markup if you need to sell them in a hurry. It's like buying a new car. Okay. The second rule that he gives is to leverage your ability to buy things by using borrowed money. Generally, this is not a recommended idea for retirees. However, there is a subset of this that may work for you. Low fixed rates, if you can tie it up and get something that's yielding a higher rate, it's like getting free money. This is one of the reasons why mortgages are such an important financial instrument. For instance, right now inflation is 5, 6. Today I listened to a podcast where a leading financial advisor says the real headline inflation in America is actually 7%. Yet you can still get a mortgage here in Israel, in the United States, and in many other places at 3%. So if you can get a mortgage for 3% and tie it up for 10, 20 years and use that money for something responsibly that has a good chance of doing things for you, you've gotten a free money, especially if there is no penalty for paying it back early. And if inflation turns the other way, you haven't been successful in investing, just give the loan back. Okay? Now, the last point is one of our mantras here, diversification. Never, ever put all your assets in only a few places. Over the years, I can't tell you how many people have come to me crying that somebody told them that they had a great idea for an investment. They convinced them, they put their entire retirement or their entire inheritance in it, and 6 months to 2 years later, there was nothing or almost nothing. The only way to invest is to widely diversify, and that can easily be done with the things we're going to talk about. we're going to cut out on the buy equity list everything other than stock market things and real estate, because everything else involves some expertise, which you may have and you can develop further, but be wary, okay? One of the things that Morton Shulman says at the end of the edition of the book that I mentioned earlier is that he went back and he looked at all the advice books that were bestsellers on the New York Times list in the years just prior to when he wrote that book. And if any of you wanted, I'll scan that chapter for you to read. It's truly sad what the story is. In one case, there was a book that told people to invest in 4 specific things. And within a year, 3 of those things were almost worthless. And when he publicized that in his radio broadcast, he got a major lawsuit from the author of the book. And Morty Shulman's lawyers apparently went and showed the homework that had been done on the results of the investment book. And then the author of that book offered Shulman that he would drop the lawsuit if he would cover his legal costs. Shulman declined and the threat disappeared. Okay, so there are no major answers. Sticking to your basic knitting, the things that have worked time and time again are the most important issues here, and not to put all your money into 1, 2, 3, or even 4 investments. To diversify as widely as possible. Let's go on to page 10. This is a graph of the S&P 500 index of the New York Stock Exchange for the last 150 years. Overall, it's pretty impressive, but I want to point out a couple of things. As you can see that on the left side, it starts from the number 100 and then goes up to 1,000. And then from 1,000, it goes through 1,500 and 2,000. The distance between 1,000 and 2,000 is called a logarithmic scale. In other words, the more it made, the slower is the increase. So if this had been a nominal scale, that graph going upwards would look much more like a rocket ship. So this is a logarithmic scale. Now, the second thing that I want to point out to you is there are major gaps between new highs. So we have from around 1910 to 1930, where it until the late 1920s, where it did not reach a new high. And once it reached a new high, it dived into the depression of the 1930s, and it didn't surpass nominally its previous high until the early 1950s. Huge amounts of time where if you just bet on the stock market, you wouldn't have done well. Again, we can see that in the period from 1969 until the earlier mid-1980s. And then from the year 2000 until about 2009. And now we've had a drop again. Just in case you're curious, Friday afternoon, the S&P 500 closed at 4,662. So far this year, the market has been overall positive. So what does one do when the major indices aren't doing well. So let's turn to page 11. So here we have examples of different subsectors, the dozen or so major subsectors where stocks are assigned to different kind of industry classifications in the stock market. I'm not happy with this chart, but it's the best I could find because it's only talking about inflationary periods over the last 22 years. However, you'll see that certain sectors have done much better than other sectors. On this list, oil and the energy sector has been highest, and the emerging markets sector of this worldwide stock market has performed the poorest. If we had looked in the 1980s or 1990s, we would have seen that emerging markets was one of the best. Okay, so there are ways to do the stock market, particularly if you're invested in things that are income producers. We'll get to it a little bit more later on, but I want to get to the second area that we think that everyone should look at seriously. So let's go on to page 12. I'm not going to waste your time and read to you these quotes that were taken off the internet that I think are an example of why real estate has to be a major area for people who want to stay ahead of inflation. Let's go on to page 13. Okay. From my experience, I may be wrong, there are 4 ways to own properties, directly or indirectly. The first one is the only totally direct way, is to go and buy additional houses, commercial properties, etc. Question is, if you're going into retirement and you don't have much experience with this, are you going to turn that into a successful business? Because it's something you need to stay on top of. On the other hand, there are probably a few people here listening to this podcast who are saying, yes, that's something I've done. And that's something that I want to give as an inheritance to my children and grandchildren. In which case, this is how we go and pass on our legacy to others. But each person's situation is different. And for most of us, to become property managers or to help supervise a family property syndicate in retirement is not going to work. Here in Israel, there is on paper a really excellent way to go and buy things at a discount. And that's called a kfutzat rechisha, where people get together, buy a piece of land, and organize through a leader the rezoning, the demolition, the construction, etc., and work out all the details. The problem is that this area of investing is not partners involved. There are great deals. Generally, you can save as much as 20% off of the market value. But unless you're doing it with people who have experience and can advise you, this can mean that your dreams will not come true in 3 years, but may take 10 or more years. And some people take permanent losses as well. There's an American and European and Canadian version of this, and they're called private placement real estate deals, where somebody who is registered with the securities authority there, is putting together groups to go and buy things with him. This helps him put together the down payment so he can get a good deal on mortgages, etc. This is what our speaker, who will be speaking right after me, is going to tell you about, because he does that and has been doing it for many years. This is a way to go. Usually the amount of money you need to put in is minimally $25,000, $50,000, maybe $250,000, but you don't want to put all your eggs in one basket. You want to try different ones. Some are for income, some are for growth, some are for both. There's all kinds of things out there. And that's something that Yitzchak specializes in, and he's brought one of the people that he has used over the years in America that does private placements to be our speaker right after me. Finally, there's another way of investing in real estate, which is reliable, and it's an area where it's very well regulated, and there are independent analysts doing it. They're called real estate investment trusts. These are companies, the equivalent of companies on the stock exchange, except they have a different legal and tax standing, so they're called REITs instead of corporations. And these can give reliable returns. Just to give you an example of a hot REIT in the last couple of years, is there are several of them that are owning and operating computer farms. When you go into the cloud, your information is interacting with computer farms located in Scandinavia and many other places that are processing and holding your data. So REITs is another way to go. Now we're getting to the end of what I have to tell you about. One of the things is to keep everything as simple as possible. So let's go on to page 14. In order to have everything work for you almost automatically, particularly if you're not always here or not always healthy, we recommend a money management system that we have talked about many times. You can get one of our other videos that talks about it with Moshe Yonas, who's the person who manages it for our clients. And he helps you put together a system so that your bills get paid through your regular bank account every month. And you don't have to worry about bill paying, getting things done on time, and it helps you to live within a budget. It's also the place for developing your emergency fund. It's really important that everyone have an emergency fund here in Israel, because at times when things are not going well internationally, it's hard to get our money from abroad. Let's go on to the next page. In terms of the money that you may be keeping abroad or that you want to use for international travel, for investing, etc., we recommend very highly that you have in the United States a cash management account, a CMA. It's one place where you can do most everything: checking, Visa card usage, savings. You can have your IRAs or other types of tax advantage accounts there, and you can do all your investing, all from one or two basic accounts, which are available on the internet real time and on monthly statements, downloadable every month, so you know what's going on, to keep everything simple, not only for yourself, but for those who may have to step in and help take care of you. It's easy to follow. There's very low ongoing costs. It's tax efficient. being able to use an account like this means that for day-to-day usage, you don't need to use a money changer because you'll get everything exchanged for free at almost the AACI, the middle rate, in shekels or any other major international currency. You have 24-hour access to people to help you who speak English as North Americans. And the last thing is that if you're Canadian or from any other country other than the United States, you don't know what you're missing until you see how you can centralize everything in a cash management account, including doing all your investing. Finally, a couple of words about ourselves on page 16. We believe that we can go and provide you, oops, something went wrong there, that we can provide you with a service, partly because we've been through it before, and partly because Israeli charge cards is not related to this, but I don't know why that's there. And because we take a neutral approach. Our approach in terms of working with people is, first of all, to see what they need, whether we can help them or we can send them on to someone else who helps them, because our perspective is not to be selling specific financial products or tax services or anything else, but to go and provide what's called a family office approach, which is what the multimillionaires do in terms of hiring staff to manage their financial affairs. We hope that you'll understand what our approach is, but more importantly, let's get on to our next speaker. The last page tells you how you can contact us, etc. So I'll turn things back to you, Yitzchak, and we'll move forward.
Okay, very good. First of all, I wanted to give people again another opportunity to be able to send in your questions below on the chat, to type in your questions. We have time for that. Our speaker will be coming up shortly. Mark, if you wanted just to add a few more words, I'll let you know when our speaker is available.
Okay, so inflation, I gave you theoretical numbers, 6%, because that's what was in the newspapers last week. But inflation is going to vary. If we're being optimistic, 2021 was an outlier year. If we're being pessimistic, we're getting into the syndrome that started in the mid-1970s and didn't end in the United States until 1981 or 82, and here in Israel didn't end until 1984, where we had multi-digit inflation. At the height of the inflation in the United States, mortgages were carrying an interest rate of 14% fixed for up to 30 years. Today, you can get a mortgage yet, depending on the terms, of under 3%, at worst, up to 4%. The compound difference on 4% into 72 means that 4 into 72 goes 18 times before you have to use, you've doubled your costs. If you have an 14% mortgage, it means that you're every 5 or 6 years, your costs are doubling due to inflation. So, meaning the balance increases. So it's a problem. We don't know what this future is going to be. The point of today's seminar is to go and give you information and a different way of thinking.
Okay, good, Mark. Perfect. Let's stop you there. And again, as I say, people are welcome to chat your questions on this topic in particular in terms of inflation, because we know that one of the consequences of inflation is that it pushes what's termed real interest rates lower. So depending on one's benchmark, like short-term interest rates today, is about minus 6%. So when people say they decided not to do anything now, they're just going to sit tight. Well, really, their money is eroding. So that was part of one of the reasons behind having this particular seminar and why we wanted to bring this particular guest to our program now. I wanted to welcome Larry Solomon from Melrose Solomon, who has been a manager with real estate investments and a consultant in asset management. He was a senior leadership positions with Barclay and UBS and other places, and currently I think manages his real estate portfolio over $100 million, something like that. Larry, if it's different, you'll correct me. Welcome to the program, Larry Solomon from Melrose Solomon.
Thank you, Yitzchak. Very nice to meet everyone, and appreciate you taking the time to speak with me. Let me tell you a little bit about our business and my views on how investing in real estate, may be an effective way of dealing with expected inflation. So my family started investing in real estate in the 1980s in New York City. Back then, you could buy a townhouse in New York City for $100,000, and my parents just saw the writing on the wall. And I grew up on Sundays visiting townhomes and during the week helping them keep track of rent payments coming in. Of course, my parents' portfolio did very well, as the Upper West Side of New York City boomed over the next few decades. After my day job at McKinsey and then a few different investment banks, I went into the family business, initially in multifamily, but now focused largely on retail, office, and industrial. What I like about this particular focus is we tend to buy buildings that are generating 7, 8, 9% day one, unlevered. When you can borrow money at 3, 4%, and then you're collecting money at 7, 8, 9%, of course, and your returns go considerably higher. Most of our investments tend to generate annual coupons of 8% cash on cash in investors' pockets, and an additional, let's say 3, 4% of paying down the mortgage each year. And what I like about these is we're not really projecting that much good has to happen in the future. We're simply making a lot of money today, and that leaves us in a position that we can deal with potential surprises by virtue of the fact that we have strong cash flows. One such opportunity that we just signed a contract on would be a good illustration of the types of deals we do. We currently own 5 buildings in Indiana right next to a military base. Those buildings are rented out to defense contractors who want proximity to the base. We are now in contract on a 6th building there. This building is a brand new building, 10-year lease signed with a defense contractor called Mantech, which is publicly traded as a $3 billion market cap. And it's a 10-year lease. So, barring some very extreme scenario of something bad happening to this tenant, we know exactly what we're going to collect over the next 10 years. We're looking at loan terms of either 5, 7, or 10 years. So we'll know exactly what we have to pay out over the next 5, 7, or 10 years. So this is a nice opportunity to clip coupons at a very large amount, probably 7 to 8% per year, which is far ahead of where inflation is, in addition to reaping significant tax benefits, at least for American taxpayers. Yitzchak, are there particular?
I was just going to jump in. I was just going to jump in to ask the last point you just mentioned. Why is it an advantage? Could you clarify or could you expand on that?
Well, generally, real estate is perceived to be a good hedge against inflation for two reasons. First, you're collecting income from tenants over time, and as inflation grows, your tenants will have more money to pay you. Second, your debt, which has a fixed amount that you have to pay out over time, your debt costs less and less. So in other words, take an extreme case. So in this, for this particular deal, we're buying a building for $11 million. We're borrowing $7.5 million in debt. So take an extreme case where in 5 years, the dollar is worth half of what it is today. Well, that $7.5 million that we just borrowed is only worth half in 5 years from now, right? So the debt that we've borrowed is more, we have to pay back much less on a real adjusted basis. So to recap, real estate is attractive on an inflationary environment for two reasons. First, as your tenants have more money, they're able to pay you more. And second, the debt that you're borrowing is worth less in the future, meaning that it's cheaper for you to pay it back in the future.
Okay. We had also another question that just came in. I think it was from Sally. It was a question that I wanted to ask you as well. You mentioned about tax benefits to Americans. So we're all interested to hear about tax benefits.
Yeah, sure. So under the IRS tax codes, real estate buildings depreciate according to different tables. What this means, and during the Trump administration, the amount that could be depreciated was accelerated significantly. So in most of our investments, for every dollar that an investor puts in, they typically see a 50-cent loss, so a 50% loss year one, which can be used against any passive income. So for example, let's imagine someone owns a business or another real estate company, which is giving them $100 a year. If that investor were to invest $200 in one of our deals, or frankly, anyone's deals, they would get a $100 loss from the $200 they're investing with us, which would effectively wipe out their $100 gain from their other business. Now, if you don't have another business generating income, which you could use, against this loss, what you can do instead is you can simply carry these losses forward so that all the income our investment generates for you would be tax-free, right? Because you can continue to use these depreciation losses against any income. So if we're paying you 7 to 8% per year, that's 7 to 8% tax-free.
Okay.
Now, I can't speak to foreign tax codes and how they would operate. I'm only familiar with the IRS code.
Okay. Another question we have from Bruce, he makes mention that the Upper West Side of New York that had been populated with a lot of tax incentives, low income housing, and as a result, he was saying that the neighborhood's changed for the worse. So he wanted to know, in your experience, is that a negative to your investment there?
Well, that's a good question. So my parents were buying in the 1980s. So they sold a fair amount in the 90s. They continue to hold some things today. My father passed, a while ago. But by and large, our focus now is on the Midwest and the Southeast United States. So to answer your question, the townhomes that we still have in the Upper West Side probably are adversely affected by some of the recent trends in New York City. But for any of the conversation that we're having now and the deals that we'd be talking about with investors now, that's not really a geography that we focus on.
Mm-hmm. Okay. Also asking that in terms of Corona pandemic, a lot of the real estate deals that you have are sort of more, let's say, pandemic resistant. Could you explain it?
Yeah. So that's a good question. I would say the impact of COVID, there's a short-term impact to real estate, and there'll be a long-term impact to real estate. So in the short term, from what we've seen, multifamily has continued to be fairly strong. Retail was initially hit quite badly, but over the last 6 to 12 months, retail has been exceptionally strong. Office has been under some pressure because at this point, you've had a number of employers who are tenants in office buildings who really haven't been in their office in almost 2 years. So it becomes very difficult for those tenants to make long-term commitments to renew or take new office space when they haven't got much benefit from their offices in 2 years. Now, everything I just described is a short-term phenomenon. At some point, COVID will be gone, whether that's 6, 12, 18 months from now. And the question is, how has life changed now that people have gotten used to certain trends introduced from COVID? And the short answer is no one knows. For instance, will employers continue to allow employees to work from home once there is no danger from COVID any longer? There's all sorts of opinions about that. And I don't think anyone knows definitively. For this particular investment, and frankly, investments that we're generally looking at, we're trying to look at things that we think are somewhat insulated from COVID and work from home. This particular investment, like all of our other investments in this military complex, is right next to a military base, and the military base requires defense contractors to maintain a physical presence so that they can test out equipment with them, they can have meetings with them, and so forth. The soldiers at the base certainly aren't going home. So we think this is relatively insulated against the work from home trends that you've seen. And the fact of the matter is this tenant has a 10-year lease. So whether they want to be there or not, they have to pay rent.
Right. Right. So you know what your cash flow is. Okay, well, if there are not any other questions, then I want to say thank you, first of all, to Larry Solomon from Melrose Solomon, and we'll give people your contact details for those who may want to speak to you further, to follow up on some of the things that you spoke about. So thank you very much for joining us. I wish you a good week.
You're very welcome. Thank you for
thank you.
having me, and thank you for asking some insightful questions.
Okay, all the best. Take care.
Take care.
All right, so we're going to continue now. If you have any other questions before we wrap it up, you're welcome to still chat in. And Mark, for a wrap up.
Oh, you want me to say something? Okay.
Well, let me give you an
right.
introduction and give you a chance to think about it then. But
All right.
we're going to give out additional information to people as well following the seminar, and whenever other thoughts you wanted to share to wrap up.
Yeah, so let me just explain what's happening. Hopefully everyone got the 2 emails before today's seminar, so they had a bibliography so they could chase down more information on the subject of inflation, and they got the slide pack so they could follow what's going along in case we had any kind of technical problems. In the next couple of days, Yitzchak and I are going to put together a number of articles and various extraneous information that is related to investing in an inflationary environment. And we will be sending out to you that list of materials along with all the contact details for myself, Yitzchak, and Larry, and the people at the AACI, so that you'll be able to do things. Yitzchak usually volunteers to get in touch with people afterwards just to see if there's any questions to get answered in private that aren't appropriate to be asked here in a public forum. And you'll have the information and our contact details. So if you have questions down the road or need anything, we'll be happy to help you.
Right. Thank you very much. Terrific. And also we'll let people know that it's being recorded. So if you want a recording of it, or you know of a mate for family people or friends or others that may want to have the recording, we hope to have it up in the next few days on YouTube. You can contact us if you wanted any more follow-up. And we thank again the AACI, to Leah and to everybody else, and to Mark and to Larry. Wish you all much success in being able to combat the financial seas that we have to encounter on a daily basis. Thank you very much.